Hey everyone. To start off, I want to highlight that this week on Thursday, January 18th, Marcus and Millichap will be hosting a complimentary webcast featuring Moody's chief economist, Mark Zandi. We had Mr. Zandi on a webcast at the beginning of last year, and the information he shared has proven to be exceptionally insightful. I encourage you to register for the webcast on our website, marcusmillichap.com. Now, for my video this week, I'm going to focus on an inflation risk that has started to become a little concerning. As you may recall from some of my past videos, one of the more important inflation drivers following the pandemic was tied to supply chains, specifically shipping costs. I highlighted that the cost to ship a container of goods from China to the west coast of the US increased from about $1,400 per container before the pandemic to a high point of $19,200 per container in September 2021. As the effects of the pandemic waned and as China ended their zero COVID policies, shipping costs started to come back down, and that has been an important factor helping to reduce inflation. By June of last year, the Trans-Pacific shipping cost was down to about $1,200 per container. But recently, shipping costs began to rise. And that has the potential to put upward pressure on inflation again. Increasing shipping costs are tied to two global shipping choke points, the Suez Canal and the Panama Canal. And the issues shrinking the throughput at these two very important shipping channels are completely different. One is tied to geopolitical issues and the other is tied to climate change. On average, about 60 ships transit the Suez Canal each day, which is about 30% of the global container traffic. But in recent weeks, Houthi attacks on container ships in the Red Sea have forced some shipping companies to reroute the container ships around the Cape of Good Hope, the southern tip of Africa. At the same time, the Panama Canal, through which about 7% of global container traffic travels, is suffering from a drought that has reduced the flow of container ships by 37%, from 38 ships per day to 24. The net impact of these shipping disruptions has been a sharp increase in container shipping costs. The cost to ship a container from China to the US West Coast has increased by $1,000 in the last month, from about $1,700 in December to about $2,700 in January. Sending a container from China to the US East Coast, which would normally transit one of the two canals, has gone up even more, from about $2,500 per container to about $3,900 per container. Now, shipping costs are nowhere near where they were in 2021 and 2022, but the very quick and significant increase in shipping costs has the potential to stall the broader trend of falling inflation we've been experiencing over the last 18 months, and this could affect commercial real estate in a couple of different ways. First, just the threat of increased inflation pressure could cause the Federal Reserve to be more cautious in their rate policies this year. Currently, Wall Street expects the Fed to reduce its overnight rate to somewhere in the 4% range by the end of 2024. But if shipping costs remain elevated for several months and those higher costs trickle into the price of retail goods, the Fed may be more conservative in their rate movements, keeping interest rates higher for longer. And that, of course, could sustain higher lending rates and slow the recovery of the commercial real estate transaction market. The other effect of the renewed supply chain disruptions is that it reiterates the importance of reshoring and nearshoring manufacturing. The trend of bringing more manufacturing back to the US has already gained significant momentum, enhanced by the 2021 Infrastructure Law, the 2022 CHIPS and Science Act, and the 2022 Inflation Reduction Act. These three initiatives put government dollars to work on building out major manufacturing and production capacity upgrades in the US. In addition, many companies have been boosting their manufacturing capabilities in Mexico, and several points of entry along the southern border are being upgraded to accommodate more traffic. These changes will affect supply chain routes, warehousing needs, job creation, and housing demand. In other words, reshoring and nearshoring have the potential to dramatically affect all types of commercial real estate demand over the next several years. And the disruption of the flow of ships through the Suez and Panama canals will reinforce and potentially speed up those reshoring efforts. Now, as I wrap up, I want to point out that the issues with the Panama and Suez canals really just started heating up in the last few weeks, but they have the potential to dramatically affect the commercial real estate investment climate throughout the coming year and even beyond that. It's an important reminder that investors need to monitor issues all over the globe and to keep their eyes on the horizon.